Welcome. It's Tuesday morning. We are on the floor of the New York Stock Exchange. We are here to talk about the market with my guest, that is Mark Otto, that is a managing director at J. Stryker and Company. Mark, thank you so much for being with us.
Thanks for having me back.
So, Mark, now we are back in the green for the stock market, the U.S. stock market. But we had a very, very bad week last week, the worst since 2012. A lot of people are thinking that we might be at the beginning of a correction phase. But today we are bouncing back. What do you think?
Seems that everyone was sort of waiting for the other shoe to drop or looking for a reason to sell. So, with the unwind of QE3 on the horizon, regardless if it's sooner or later what the taper rate will be, it is going to happen. So I think portfolio managers ended last year on the high. They're looking for a reason to take profits and take risk off the table. And it seems that the Chinese manufacturing data was enough of a trigger to actually start that process. It spilled over into the emerging markets. People ran from equities into safe havens. Gold rallied. The volatility index spiked. And people actually were buying up the yen. So the currency fluctuation also played into the game. Yesterday, we saw what we call here on the floor a dead cat bounce, which is basically a mirage, a sort of fake rally. So there was some pretty good volatility in the market yesterday. It did close off the lows, so that is somewhat encouraging. And in one day, what a difference a day makes. Right now, we're closing in on 1,800 again, the S&P 500. So we'll have to see. We have the State of the Union tonight. And, some more macroeconomic data to come.
And you were mentioning China, of course, probably was an excuse for the market to go down. Those numbers, the manufacturing data that we had, are they really enough, according to you, to just be scared? Okay, let's leave alone the market reaction, but how concerned are you about China?
I'm not really. I mean, I think what it is that, like, if China says 7.5, GDP for this year, everyone thinks automatically 8. If they say 8, everyone thinks 9 or 10, and that's the way it's been for years. So I think that a lot of the numbers that they're coming up with as far as projections are probably more realistic. I think they're bringing everybody's expectations in line. I'm not worried about China missing their targets for the year at all. I mean, we're very early in the game. We just started 2014. Something that I am concerned with is China-based U.S. stocks. A lot of profits have been taken out of them in the last couple of days. And I was waiting to see when our market rallied if they would break correlation and follow through. A lot of it has to do with the SEC filing suit against the big four accounting firms that are doing audits in China. So, in the worst case scenario, if that follows through, it could be detrimental for China-based U.S. companies. So I was waiting to see when our market rallied if they would continue to fall. However, a lot of them are rallying hard today. So it's definitely encouraging, especially, since we're anticipating hopefully as many as 20 China-based companies are going to list here in U.S. markets this year.
Wow, it could be a very good year for the IPOs. Now let's talk about the Federal Reserve. Today is the first of the 2-day meetings. Tomorrow the announcement. We don't know if we're going to have an announcement about another phase of tapering. A lot of speculations last week. There was a journal article. A lot of people are saying that probably, as you were mentioning, the expectation of another taper just had an impact on the market. So what are your expectations for tomorrow?
I think that they're going to probably follow through what we've seen in the past. The language will probably be pretty cryptic. And I think traders always draw their conclusions off that. And a lot of those conclusions create more volatility in the market. So I think there could be overreaction off the language. However, it's going to be like the Super Bowl. Tomorrow, everyone's going to be waiting at that particular moment in time to see what type of direction that they're going to have or influence on the market.
How about the Ben Bernanke's speech? Do you expect, if of course it's going to be a farewell, but do you expect a little bit of uncertainty, waiting for a clear message from Janet Yellen?
I think at this point, with the way that everyone sort of sees forward-looking guidance is not being so clear at all. It might be nice if he just says goodbye and passes it on and says, "Okay, Janet Yellen, it's all yours now."
I'm done.
Yeah. So it would be nice. It wouldn't shock me if he does have something a bit cryptic to say that may cause some overreaction.
So now let's talk about the economic data. You were mentioning a lot of economic data. We're gonna read the GDP as well. The numbers that we had today about the durable goods orders, they're really disappointed. They've been revised down also for November, and we might see a lot of the expectation, the forecast for the GDP for the fourth quarter revised down because of the data. So what are your expectations?
Well, definitely, a lot of the times GDP doesn't really have as much weight as some of the other macro data. Durable goods is definitely a heavyweight. So we will have to see this time, because of what the numbers came out for durable goods, if GDP will actually be more closely watched this time. So, I think everyone's sort of looking for a catalyst right now. Earnings have been mixed. What is nice to see, though, is even though we are looking at China's manufacturing, even though we are looking at what's going on in the emerging markets, what's the movement in gold, the yen, whatever it is, at least we're looking at fundamentals again, right? It's not like the market is just hinging upon what's going on with QE3 and when are they going to take their foot off the gas pedal and ease up. So I'm happy to see that we are going back to fundamentals. If this is correction, I think that's actually a healthy thing. The market, can't continuously go higher and higher and higher without eventually coming to some sort of an ugly ending. So, I think these pullbacks are a healthy thing. Obviously we don't want to sell off and things get much worse. But, already in one day, we're already closing in on 1800 again. So I'm not too worried about it at this point.
Yeah, that's why a lot of people are not really considering this a correction, because we are not piercing through very important levels. So give me some numbers that we have to look at.
Yeah, I have to look up because actually the SP 500 keeps going up as we're talking. So from here, 1795 resistance, obviously 1800 is going to be a psychological point after that. On the downside, 1788 and then 1781 for support.
Okay, so if we don't go down 1781,
Right.
it might be 1788.
Yeah,
It might
if
be.
it cracks through and it really starts to sell off, then you have to look at 1760.
Okay.
All right.
Okay, perfect. Thank you so much, Mark, for being with us.
Thank you.
And thank you for watching.